So Rick, you mentioned like having like a 5 to 10 year outlook and such, especially on gold and some of these other commodities and such. So let's start with you, Rick. Where do you think gold could be? With all of these dynamics and all this money print.
I look at the decade of the 1970s as prologue. I think that was the last period where you had sustained and dramatic declines in the purchasing power of the U.S. dollar. And I think we were lulled by the period 1982 to 2022 into forgetting the lessons of the decade of the 70s. In the decade of the 70s, according to the government, the U.S. dollar lost 75% of its purchasing power. Not coincidentally, I think, the gold price increased 26-fold. I'm not suggesting, by the way, that gold is, don't get your listeners' hopes too high, Daryl. I'm not suggesting that the gold price is going to increase 26-fold. But I suspect that gold will maintain its purchasing power. If that happens, one could expect the price of gold to mirror the decline in the purchasing power of the U.S. dollar. A doubling of the gold price, the nominal gold price, over the next 10 years would be, from my point of view, a conservative estimate. If I'm right, if gold maintains its purchasing power over 10 years in the face of a decline in the purchasing power of the currency that the gold price is measured in, it wouldn't surprise me to see the price of gold up threefold or fourfold. Which is to say that gold would purchase approximately the same basket of goods and services 10 years from now that it purchases today, while the U.S. dollar would purchase substantially less by way of goods and services than it does today. I realize it's not an accurate number that you're looking for, Daryl. I'm not good for headlines, but I suspect that savers should anticipate that gold will, as it's done for millennia, preserve your purchasing power. Daryl, as you know, I began denominating a substantial part of my savings in gold in the year 2000. And when you look at price levels from that metric, gold has increased in price about 9% compounded since the year 2000. When you do that, real estate is cheap. And energy is cheap. Groceries are cheap. Health insurance is cheap. When you measure the price of goods and services in the normal denominator, which is to say the U.S. dollar, all of those things are expensive. I think the lessons of the period 2000 to 2026 will become more manifest in the period 2025 to 2035. And I'm not suggesting, by the way, Daryl, I maintain U.S. dollar liquidity. I'm not suggesting that people save only in gold. I'm just suggesting that people consider allocating enough of their savings into gold so that the experience that I've enjoyed in the last 25 years extends to them over the next 10 years.
Okay. Dr. Thornton, what are your thoughts?
Well, I concur. I mean, when I look back from 99 to 24, what we did see is that gold was able to match or slightly exceed the emissions in the money supply, so that gold did as well as what the Fed was doing to bring down the economy. So it offset all of that. And it actually did better than stocks, which were relatively robust over that same 25-year period. I'm not sure that we're going to get a repeat of that going forward for the next 10 or maybe even 25 years, although it's hard to look past, the next 10 years out is difficult enough. But I suspect that not only is the U.S. and other central banks going to increase the amount of new money that they're injecting in the economy, but that money holders, individuals, companies, other nations, and so forth, are going to be less interested in holding U.S. dollars the way they were in the past. This is a point that Mises makes. And he says that decrease in the demand to hold money, or the dollars in this case, is really a prelude to a hyperinflationary environment, because if they're increasing the supply and people are decreasing their demand, it means that that purchasing power of gold in this case is going to go up faster than the rate of monetary emissions. So the returns on gold may go off trend, may go above trend over the next 10 years, and particularly in the sense that, foreign holders of U.S. dollars in the Middle East, I suspect, are going to be less interested in holding dollars. The Chinese are already, and the Russians are already less interested in holding dollars. The same with the Indians, and I think the Japanese are thinking twice. And the Europeans, who hold a large amount of dollar-denominated assets in the U.S. economy, are probably also thinking. And, of course, there's the illegal markets and drugs and so forth, where they hold a lot of U.S. cash. I think a lot of those people, especially once the dollar hits a devaluation skid, or maybe the next time it does, that you're going to see this, people rethinking their general balancing of dollar holdings moving forward. And that's when gold will actually experience a higher rate of return, because we measure gold in terms of dollars.
Okay. Yes. Thank you for sharing that. Okay. So there's many different people watching at home, different financial situations, different ages and such. So I would love to get your general message to just the people of, like, what should the people really be considering at this point? And then also I would love to get your message to the younger generations, as you both speak to Students for Liberty and such, and do some amazing work. And so we'd love to get your thoughts there. So let's go ahead and start with you, Rick.
Well, the first is that the best investment that anybody can make is in themselves. Your biggest risk, even greater than government, is located to the left of your right ear and to the right of your left ear. So educating yourself as an investor, as a human being, educating yourself to deliver utility to other people in excess of the utility that you consume for yourself. The delta between what you produce and what you consume is called savings. And you're going to have to be much more aggressive saving in the next 10 years, because society's not going to be able to do it for you. So the first thing I want to say to people of all ages is invest in yourself, invest in your education. Young people, that means reading books like Economics in One Lesson, learning about the way the world is, as opposed to the way that CBC or Fox or somebody tells you that it ought to be. I would move on from there to The Intelligent Investor by Ben Graham. I suspect the best investment book ever written relative to the effort required to read it, which is little. And understand, really truly understand, that getting ahead in life materially is a function of creating utility for other people that they voluntarily consume, and creating utility in excess of the utility that you consume. It's important that you know that. So once we've covered off all that, then I think that you need to begin to apply that knowledge. And the most important investment that you will ever make is either in a job where you have a platform that delivers utility for other people, or in a business where you have a platform that delivers utility for other people. The delta between those two becomes savings. Learning how to invest it is an important thing. I have learned to specialize in my investments into natural resources and conventional financial services. I don't step out of my competency zone. I don't do technology. I don't do consumer durables. I don't do broad aspects of the U.S. economy, not because I don't believe that they're good things, but because I don't think I have enough knowledge to compete. If I'm right, and the economy is less forgiving than it will be in the future, you're going to need to develop a circle of competency that you invest in. And to the extent that you step out of that, you're going to have to invest in very, very, very big trends that you understand. I happen to agree with Dr. Thornton that the next 10 years, as a consequence really of history, will be good for I call it the stuff of humankind, which is to say natural resources. I think it would be good, too, for precious metals for the reasons that we've discussed. I wouldn't, too often, Daryl, I see portfolios that come to me for people who have bought our narrative so completely that their portfolios are 100% gold. It scares the hell out of me. I know a lot about gold, and I wouldn't put 100% of my money in gold. You're assuming that Rick Rule is never wrong, and history will tell you that that's a very, very poor assumption. But the market share of gold among savings and investors in the United States, which is to say the market share of precious metals, currently is a little above 0.5%, which is to say 0.5% of savings and investment assets of American people are in precious metals or precious metal securities. The 4-decade mean market share is 2%. I think you're going to see reversion to mean and front-running reversion to mean, which is to say denominating enough of your savings and investment assets to precious metals that you benefit from a fourfold increased demand, which is what reversion to mean would entail. I think that's very, very, very. It's difficult for me to understand why a saver, an investor, wouldn't have 5 to 10% of their portfolio denominated in precious metals, either physical precious metals if they don't want to take the operating company risk and do the work, or senior precious metal stocks if they're investors, or an injudicious mix of bullion, senior producers, and juniors to the extent that somebody is willing to take the risk and do the work.